Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we're going to do the EIA show. I didn't have a chance to do the Econ show. I was coming back from Texas and I got stuck in the FAA nightmare, so I did not get home in time. But we will get back to it next week. And then next week, because of Martin Luther King weekend, the EIA data comes out on Thursday, so we'll do Econ Wednesday and EIA on Thursday, and we'll have a lot to talk about with the inflation data. What does it mean for Q1, and how, if that will change anything for the Fed. So now in the EIA show, we're going to try to keep it a little bit shorter, just because there is a lot to discuss. But just go back and forth with where things are. We really want to look at where is demand right now. So in the first segment, we're going to talk about how did some of the stuff close out the year? Why was there such a large build in the U.S.? Is that something that is going to be continuous? Is it something that is abnormal? And a lot of it is really weather related. You had over 6 million barrels a day of refining demand go down because of weather. So again, all of these things really impact where some of the builds were, and then what is going to happen going forward. So we're going to look through that. Then in the second segment, we're going to look at demand in the U.S. How is demand shaping up? As we had said before, things started out very slow, but we do see it coming back up closer to where our target is of about, on the gasoline side, about 8.5 million barrels a day, and on the distillate coming up a bit, but again, still having a bit of a struggle just because of weather in terms of where that heat wave is. Then in the last segment, we're going to go through, what is happening with diesel flows for Russia, what's happening with pricing. We've started to see a little bit of a creep up in the physical market. So right now, that just means that based on some of the physical pricing, things are fairly stable. We don't see too much up or down. And if anything, we should start to see some of the diffs, tighten up just a bit. We are getting a little bit more purchasing, and we want to look at how that is shifting in the global market. So with that being said, diving right into segment one. So this is just closing out the year. So this is looking back 2 weeks, so you can kind of put it all into one spot. The deficit narrowed from 19 million to 5.7. So for total oil product stockpiles, you can see things close kind of right on the nose of what the average is between 2017 and 2019. Total crude stocks, land and floating, flipped to surplus from minus 3.1 to plus 26.4. And again, a lot of that was driven based on the floating storage side. As we've been really trying to drive home, there is that big issue in terms of where is the crude? Is it in transit? Is it in floating? And that is something that is going to continue, given the miles per ton that have really increased and the distance in which a lot of this crude moves. Total oil product stockpiles, the deficit widened from 15.9 to 32.1. So if you think about the shift in terms of volumes, you had a decent amount of weather, which again put crude into storage. But then if you have crude in storage, well, what does that mean for product stockpiles? Well, you draw them down. So that should start to balance out in general, but you're getting an idea of kind of where things closed out the year. Then when we start looking at what's happening in Europe and some of the other areas, Kazakhstan is ready to send its first pipeline shipment of oil to German refiners later this month. There's going to be about 20,000 tons of crude, which will flow through Russian pipelines in January. So it's going to be interesting to see how this progresses. Is it something that Russia is going to let happen over the longer term? Total supplies to Germany this year could reach 1.5 million tons, which is about 30,000 barrels a day. So the question is going to be does Russia let that happen continuously? Germany is typically one of the largest buyers of Russian crude. Just to put that in context as to why does that matter? Well, that would help shorten some miles. It would open up some of the opportunity for Kazakhstan and increase some of those volumes. But it would also displace some of that crude that would be coming from the Middle East, as we talked about not last week but the week before. When you had some of those, we did do it last week. Last week, where we talked about some of the issues that the Middle East was trying to address, especially with Saudi Arabia cutting OSPs, and how that still wasn't really going to be enough to move it into the European markets. So then when we start looking at land storage, here you can see the deficit narrowed from 47.8 to 32.5. So still on the low end, but again, a lot of that was stuck offshore, as we've been saying. West of Suez, the deficit narrowed from 30 to 18.5. East of Suez, the deficit narrowed from 12.3 to 7.6. So again, things were tightening up, but a lot of that was that the latency going from offshore to onshore starting to close. But again, we still had a lot of crude offshore, and that's not something that has changed. So when you look at floating storage, the surplus widened from 31.8 to 32.1. We in the west of Suez, we flipped to a deficit from plus 6.9 to minus 5.2. But then in the Middle East and Asia, it went from surplus widened from 25.5 to 30.8. and close right at where we were expecting. So again, a lot of this back and forth, but you could still see there is a significant amount of crude that's sitting on the water east of Suez. And as we update that with more recent data in segment 3, you're going to see that really hasn't changed. If anything, it's starting off at a very high end. So when we start looking at some of the different flows, the crude stock build, we had a build of 18.96 million. You can see that there was a big build pretty much everywhere in PADD 2, Cushing, and the Gulf Coast. Gulf Coast, there was a mixture of timing where you had, the ad valorem tax is now kicked to December 2023. Taxman goes away for the year. You know, you're going to pay what you're accrued in 2022. And now but there was also, again, there was that downtime. When you look at refining, not all of it came back right away. It takes time, as we were saying, to bring things back up to speed. You also had that disconnect between exports, imports. So when you look at PADD 3, that's something that's going to level off. But even as it levels off, you know, with a build of 15.55, you're still 23.3 million above the 5-year, 29.2 million above year over year. So you're still starting at a very high end. PADD 2 had a build of 3.72, Cushing a build of 2.51, and a lot of that, again, was some of the residual, with the only draw being in PADD 5. Factoring in the SPR, there was a build of 18.16 million. So again, you still have that sizable build. And then when you look at total crude stocks year over year, you know, we're 26.3 million. So we're starting out higher than we were in 2022, but still a bit on the short side versus the 5 years. So those are things that we're going to look at as we progress to see where are we against historics, where do we expect going from here. The charts are going to be a little difficult to read in the first week or two, just because obviously it starts as a little dot, and then as the line expands, it'll get easier to see. So I'll try to describe as to where it is. It's right between where 2017 and 2021 sit. So you can see we're starting at a very high end from the PADD 3 perspective. We don't see that adjusting too much. If anything, it will come down a bit, and that's just because exports are still going to remain strong. We're still very competitive into the European markets, and you will have imports slow a bit. But even if imports stay elevated, because even they spike, but not to a huge degree, you will get refining capacity coming back on, which will draw down some of these inventories and increase some of the storage into the refined product side. Cushing, still on the very low end. You can see it closed a bit higher, and now we're sitting here. It's just, there's nothing to say that we're not going to get a very seasonal trend. There's nothing too aggressive up or down. Again, the bigger focus is going to be LLS, MEH, and those Magellan East Houston, Louisiana Light Sweet. These are things that are going into the market. Where is that sitting? And Cushing, again, is obviously a big storage hub, but the coast is mattering more and more, but it's still an important place to look. When you look at runs, you can see that there was a bounce of only 4.5%. So we went from 79.6 to 84.1. So we did get a bounce, but not by any means the recovery of what fully came down. And we'll have a chart on that in a second. So you can see, obviously, PADD 2 had an increase of 235,000 barrels a day, PADD 3, 695. So you saw that increase, but still by no means replacing what went down, which is why we had another big build and some of those draws out on the product side. When you put that into context, you can see that little dot right there, or maybe you can't. So it's the third lowest it's been in going back to 1994. just to put in context where it is in relation, which is why we had such a sizable build. It's just you don't have refiners operating, and refiners are your number one demand driver. And if they're not operating, well, here's a hint of where that crude is going to go, and it's going to be in storage. So when you look at imports increased 637,000 barrels a day, still below the 5-year average, but you can see it's starting to pick up in PADD 2. Whereas we were saying, as Keystone normalized, as things started to pick back up, you were going to see that kind of a bit of a makeup number. That's where we are here. We should see that drop back down to about 2.5, 2.7, but that will still be at the higher end of the import side. And then PADD 3 had an increase of 211,000 barrels, but still very much on the low end. And that's still going to continue to be the case. We should see it be a little bit stronger than here, just because there is some of that excess that's sitting offshore based on what was kept offshore versus bringing on for that tax avoidance. Because remember, tax evasion is illegal. Tax avoidance is good business. PADD 5 had a drop of 486,000 barrels, but you can see it's still fairly normal, and PADD 5 is always going to be lumpy. So now when you start looking at imports, you can see it's still very much at the very low end of the range. You know, that's not something that we expect to change just because of where activity is. And again, imports are also going to marry what is coming on to the U.S. We had an increase from Nigeria. You know, that's going to start to flow through. And then based on where pricing is, we could see a little bit more coming in, but still, again, remain well below the 5-year average and still see some of those pressures. PADD 2, nice little spike. It's going to stay above the 5-year average. It's just going to stay at the very high end of that cloud, just because there is a preferential treatment of bringing in some of that crude from Canada, just based on, you know, again, pricing and and refilling some of the storage there. There is spare capacity. Obviously, as the refiners start to come back up, you'll start to see some of that normalize, but you'll still see that the imports coming through. Implied demand, you can see that there was only a very small bump in gasoline of 44,000 barrels a day. That's something that we do see a more sizable increase to about, let's call it about 8.4 million barrels a day of gasoline demand. You know, it might come up a little bit slower, maybe to about 8.2, 8.3 before we start to settle out, just because, as we said last week, January is a very slow month, and that's across the board. So we should see that on the personal side. Obviously, weather got in the way at the beginning. That's starting to ebb, you know, and we will see some of that driving. Distillate had a nice pop of just over 1 million barrels. And remember, we were saying that there was a huge cold snap during Christmas. You know, people worked through their heating oil, and then you have kind of that refill moment, and that's really what we saw here. Then you do get a little bit of an increase in just truck movements. You know, people are trying to move inventories, trying to get things cleared out. So that usually gets a nice little pop as you come in through January. Then things kind of level off as you go through February and March. But we'll talk more about that in segment 2. Jet, fairly low. You know, again, we're not changing our view where it's about 1.45, 1.55. You know, typically we're a bit on the lower end just because of January in terms of demand. So not too much there with propane, small increase of 76,000 barrels. Petchem still remains very sluggish. We don't see that changing. And as things get warmer for the next, you know, let's call it week or two before they get colder again into the end of January, February, you're going to see fairly low or weaker demand on the propane side. Gasoline implied demand, only time it was lower in the last 10 years was obviously 2021. You know, that's not something that we see adjusting at this point, but you can see that there's normally the spike. You know, you start out low, then you have that increase. It's, again, we're going to have a seasonal increase versus where we are. It's just, where do we settle off? And as we've been saying, we believe that it settles off closer to about 8.3, 8.4, with some upside to 8.5 as you get towards the end of the year. But really that 8.2 to 8.3 is going to be kind of the next stop before you get that last incremental bump going into month end. And typically we do get a bit of an increase in January, and Martin Luther King weekend is a big ski weekend, so you do get some travel. So again, that's why there's normally that bump that we've talked about. So this will be a bit weaker, and then we'll get a little bit of that residual as we go into next week. Then the crude, you can see we're actually right on the 2019 number, so that's why it's hard to see because it starts almost on the money with the white line. So you can see in realistically, there's only been 4 years higher than that. And so, again, just going to be fairly flat. The SPRs will slow. We will get some refills in terms of some of that crude coming back because remember, some of it was loaned out. Some of it is going to be repurchased depending on price. Obviously, not well. Hopefully, they don't buy it here, but we'll see what they decide to do. But you can get an idea of where we are on the commercial side. Once you factor in commercial and product storage, you can see here that we're just above where we were in 2022. So it's going to be very stable, and I think that's you can do with that what you will. But realistically, we're going to see this be fairly flat again. And you can see some of the seasonal bumps, seasonal adjustments, and we just see it being fairly stable when you factor in not only crude but also products. And then you start breaking it into its pieces. Obviously, the supply of crude oil bounced as we said it was going to because of the drop down in refining activity, and obviously the big bump in flows. Gasoline storage starting out a bit on the weaker side, but that's something that we see a fairly sizable correction in as we get that bump. Because when you look at the builds, you can see that there was a sizable build this week, and we think that's going to continue in the U.S. Distillate, only 1 year that was lower. Again, distillate is going to not be as bullish as it was because of some of the heat, because of a little bit of the heat wave, because of some of the sluggishness on the diesels on the demand side. It's still going to be positive. The question is going to be how positive is that crack, and that's going to kind of carry how well things are going to do on the refining side. Jet, very weak, but again, storage is going to be between, is it kerosene, is it distillate? That's going to be the back and forth in general. When you look at the WTI crude curve, you can see that we're still in contango. And as we were saying, just given where the demand cycle looks to be in January and February, again, we expect things to pick back up as we get into March and especially April. So we do see a weaker Jan and Feb, which is why you're incentivized to save, to store, because it'll get better in the next couple of months. So again, that's where we see that we do see some of that contango getting a bit steeper, not by much, just because of the different flows. But again, that's something that we are expecting. And then just to kick off the year, you can see that we're fairly on the lower end on the storage side. We're above where we were in 2021, and we're right at about where we were in 2019. So we do expect to see a little bit of an increase. But that's just going to be a marriage of when does the refiners in PADD 3 really start to get back operational. So we could get one more build on the floating side just because of timing, just because of that bringing back activity. But as that starts to normalize, we'll see this, stay at the fairly lower end of the spectrum. So that's what we have for you on the U.S. side. In the next segment, we're going to go deeper into what is happening in the U.S. on the demand front. How is that going to recover? What is that going to look like? And what should we expect for pricing?